Indexed Annuities 101. This is somewhat of a longer segment than most other segments. We usually try to keep them to an amount less than 15 minutes. However, this one is a little bit longer, particularly because um, it goes into another, it really transitions into another segment, which is utilizing the index, non-qualified index annuity as collateral for a financed life product to sort of double up on your return. We'll go through this rather quickly just because of the length and how many slides we actually have in this presentation. So, type of annuities, we have fixed, variable, immediate, SPIA, and indexed annuities. Traditional fixed annuities have, for an initial period, the insurance company guaranteeing a preset rate of interest based on the annuity purchased. The bottom line, they offer a guaranteed stream of income during annuitization. Variable annuities, variable, more risk, potential higher reward, but for more risk. So they do permit investment in a series of underlying subaccounts, and the account value will fluctuate as a result of the performance of the subaccounts. So really have two polar, not polar opposites, but sort of two extremes of the subset that is the annuity marketplace: fixed annuities and variable annuities. Furthermore, variable annuities have a mortality and expense cost and subaccount management fees on average 2.3%. Your 7% return is actually more like a net 4.7% return for this particular reason. Some of them additionally offer living and death benefits or riders. They do have additional charges. Furthermore, the advisor must have a securities license to sell these. Let's look towards immediate annuity, SPIA. So when we have a lump sum of money and we're going to convert it to a guaranteed stream of income, the insurer determines a variety of things: how many payments, the method of payment, how long, the duration of payment, etc. Now, let's turn towards indexed annuities. Indexed annuities are fixed annuities, and they are regulated as an insurance product, not a security. Okay, not a security. Some argue in the future they will be regulated as a security. However, they provide kind of the best of both worlds. So they're sort of the middle ground between the fixed annuity and the variable annuity, where they have a minimum guaranteed surrender value, yet they offer some upside potential tied to or linked to a movement of an external index, the S&P 500, the Dow Jones, other blended indices, Eurostock, etc. Pretty similar to an index universal life policy. However, they do offer the same protection as other fixed annuity products. So let's take a moment to recognize the difference between product design and index crediting methods. Okay, index crediting methods can be adjusted often, and it can provide for some diversification, etc. We actually used to have a CFA on staff that would advise on all of those matters, from index UL policies to index annuities, for that particular reason of flexibility. However, what we have are, and we'll cover these, are annual reset, which is the ratchet, point-to-point averaging, participation rate, and the high watermark. So annual reset or ratchet. Index-linked interest, if any, is determined each year by comparing the index value at the end of a contract year with the index value at the start. Okay, so if you start on February 20th of 2016, for example, that's when it starts. We look at February 20th of 2017, exactly 1 year later, where did that index close at on that day? That's going to determine the rate of return over time. And it's the same date every year. Allow a few weeks for the crediting to actually show in your account, which is known as the sweep period. Furthermore, it is credited each year at the end of the term. Now, annual reset. Okay, so annual reset is important because in my example, the February 20th of 16 to February 20th of 17, let's assume we had a negative performance of the underlying index. Let's assume it was the S&P 500. It performed at a negative 5% return, let's say. We would get a guaranteed 0 in this example, okay, 0% crediting. Let's imagine that's what's happening there. And then the next year, let's imagine that the index performs at 10%. So then we get a 10% return. Additionally, okay, let's imagine in another scenario, okay, completely different scenario here, that second year the index performs at a rate of return of 15%. Yet our cap on this particular strategy is 10%. Even though it performed at a rate higher than our cap, we only receive 10%. You see, your risk is mitigated on either end of this. It's sort of a middle strategy as comparing the fixed index strategy to a variable index strategy. And that's what the annual reset is doing. So point to point, here's a basic example, is imagine the point-to-point product is leading to the S&P 500. We have a start value of 800 and an ending value of 880. Your index credited is 10%. Sort of in summary of what we just discussed. Averaging, okay. Index linked interest, if any, is based on the average of an index value at a monthly, daily, or annual contract date. What I explained was annual point-to-point averaging. However, there are other averaging methods we can use, and this really is product design. The index averaging may occur at the beginning, the end, or throughout the entire term of the annuity, hence monthly, quarterly, daily, etc. Participation rate is a portion of the index change is credited to the total account value. For example, a 50% participation rate. Here we go. You're only participating in half of the index, right? So you're a little less risky, but less upside potential. So in the same example we showed, point to point, say it's the S&P 500 is our benchmark index. We're starting value at 800. Obviously these numbers are way off. However, just take them for sake of conversation. Or any values at 80. If we're at a 50% par rate and the index credits here based off this value at 10%, we're only going to receive a 5% crediting rate. Now the high water mark, okay, within this point to point, the index is decided by looking at the index value at various points during the term, usually the annual anniversaries of the date the annuity was purchased. This is important. Interest is based on the difference between the highest value and the highest index value and value at the start of the term, and it's credited at the end of the term. Okay, so it's just another, there's so many different variations of this within these different annuities for different carriers, etc. But these are just some generalities, really generalities around some of the methodologies here. So another point on index annuities crediting method, we have cap, spread, par rate, averaging. So the cap is the maximum that can be credited to an annuity during any crediting period. So if the annual point to point, if it hits 15% but our cap is 12, we'll only get a 12% crediting rate. The spread is really a charge deducted from the index gain prior to the credit paid to the annuity. So say your spread's 100 bips, you get a 10% return for that crediting period. Well, you're only going to realize 9 in this example. Par rate, participation rate, percent of index gain credited to the annuity. You may have 50% par rate, 100% par rate. We've seen as high as 160% par rate. Mind you, the cap is going to be a little lower on the higher par rates. However, when you have a higher par rate, you typically have a lower cap. So you have, historically speaking, if you take a look back, you have a less average rate of return on a 10, 15, 20, 30-year look back. However, you have less standard deviation from the mean, right? Because there's less variance within a high par, and because it's high par, a lower cap investment strategy for crediting method. So here's some examples. Annual point-to-point product with a 10% cap, 100% par rate. Those are the assumptions. Here we go. S&P gains 18%, we're credited at 10%. It gains 4.53%, we're credited at 4.53%. We lose 14%, we're credited 0. So 0 is the floor. This is within our floor and cap of 10%, and this is an amount in excess of the cap, so we get 10%. Okay, there's your summation of the cap example. The spread example. Annual point-to-point with a 3% spread. Imagine no cap, and imagine a floor of 0. S&P gains 18, we're credited 15. 18 minus 3 is 15. We gained 4.5, we're credited 1.5. We lose 14%, we're credited 0. There's your spread. Okay, par rate example. 70% par, same, everything underlying is the same. Okay, so we get 70% of this, we're credited at 13. We get 70% of that, we're credited at 3.17. We get 70% of that, well, it's actually at a negative value, so we are credited 0 because of our floor. Where would you be today if you had $100,000 to invest December 31st, 1999, just through this period up to December 31st of 2010? This is what the S&P is doing. So the percentage gain or lost from this annual point-to-point value, okay? This is the value of our investment. This is what would happen. Okay, if we were investing directly into the market as opposed to investing directly into an annuity, for example. Okay, 10% cap and a 0% floor. Okay, we are ahead $80,000 within the index annuity example. Why is that? Whenever you have a negative rate of return, your actual rate of return is not going to equal your average rate of return. All right. Average rate of return is 13% here, but your actual rate of return is far less than that. Okay. In this scenario, your actual is going to equal your average just because of the floor. So, interestingly enough, investment strategists will encourage buying low, selling high. However, in reality, this is not what occurs in the marketplace. More often than not, investors buy high and they sell low. Now let's look at the returns for the past 20 years. This is from 86 to 05. S&P 11.9%. Equity mutual fund return 9.3%. Equity mutual fund investor 3.9%. And inflation is 3%. Always take that into account, then inflation. Now, December 31st, 88 to December 31st, 2010. Okay, S&P 500, 8.2%. Equity funds, 3.17%. Equity investors, 1.87%. Dollar cost averaging, 2.7%. So there's a new trend. A new trend is created. Okay. And it's the index trend. And separate calculation from index interest credited. The client's going to receive the greater two values, either a 30% guarantee on 90%, a 3% guarantee on 90% of premium common. Okay, so here's what happens. This is our index value, and this is our guaranteed value. So the assumption here is the different lengths of 0, 0, 5, and 7. Okay. Riders, annuities have a variety of different riders. We mentioned a few of them earlier on, some of which are the income for life rider. This can be added to provide income for life without annuitization. So it's without giving up control of the underlying asset.